Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. I just have to talk about strategy again because I really want to talk about digital credit because it is the most fascinating story that is occurring in the world under any domain. This is the intersection of the war for the future of finance, Bitcoin versus the traditional system. There is nothing more exciting happening on Earth, and I really want to talk about why Saylor'S digital credit is breaking everyone's brains. We are living through a capital markets revolution, and I cannot wait to get into this, but first I want to thank Horizon for sponsoring this channel. Horizon helps you take your home equity and they help you buy Bitcoin with it. It's a glorious thing because there is no debt, there's no monthly payments, and there's no term limits either. The Bitcoin is fully yours to hold however you want to with no risk of forced liquidation. Buy the Bitcoin dip or the MSTR dip if you want to with your home equity. Join Horizon.com, their link down below, and I will talk about them at the end of the video. Let us start with the part of the financial system that everyone pretends to understand, that is credit itself. Remember, credit, the polite fiction that governments, corporations, and consumers are all functioning adults who borrow money today and return it tomorrow with a little extra for their troubles. That's what credit is. The entire structure of traditional credit, it looks very orderly until you examine the assumptions that it's built on. The modern credit system only works because it assumes that money can just be created indefinitely without any consequence. Every rating model, every duration calculation, every bond prospectus rests on the idea that liquidity is some infinite resource that comes out of the ether. If something breaks, well, a committee increases the supply of money, and they call that stability. This is treated as a sophisticated policy instead of the monetary equivalent of duct tape. The next assumption is that the collateral must be physical and tied to some specific jurisdiction. So think property, think factories, think inventory, think physical things that act as collateral. Think the vague promise of future tax receipts. All of these forms of physical collateral, they bring all kinds of risk into this world. Think political risk. Think operational risk. Think liquidation delays that can stretch on for years. Investors compensate for that uncertainty with artificially low expectations because the system has conditioned them to trust institutions more than simple arithmetic. These assumptions were tolerable when everyone believed that the monetary base could be managed forever. But once you introduce a form of capital that does not bend to political incentives, the legacy assumptions behind the old collateral, they reveal themselves as quite fragile. The traditional credit world becomes a museum of outdated engineering. Bitcoin is making it irrelevant. It still functions absolutely, but only because people refuse to admit what their models just ignore. And this is why legacy credit is mispriced, because investors are pricing debt instruments as if dilution is impossible, as if collateral always retains value, and as if interest rates are controlled by rational actors in this world. But we all know that's not true. None of those claims survive contact with reality. The results just speak for themselves, obviously. Trillions of dollars locked in low-yield instruments that depend entirely on the credibility of institutions that have already demonstrated a willingness to change the rules whenever they feel pressure. So the point of this presentation isn't to attack the old system, it is to explain why it is structurally incapable of recognizing the arrival of a harder monetary base. These markets that were designed to operate around elastic money and political collateral, they cannot rationally price credit that is built on a fixed supply asset with global liquidity like Bitcoin. The old assumptions, they break the moment the underlying collateral improves faster than the old models can adapt. And we are living through this right now as we speak. And once you grasp that core issue, everything that follows just becomes obvious, and you view the world through a Bitcoin lens. The system is mispricing risk at a fundamental level because it is built around a worldview that no longer matches the environment. And when that base assumption collapses, the credit products that are anchored to them eventually reprice in violent fashion. That is the backdrop for the digital credit revolution that is spearheaded by Michael Saylor. This is not a technological upgrade necessarily, it is a structural correction to decades of complacency in the capital markets. To understand why Bitcoin functions as that superior base of collateral, you have to start with the most uncomfortable truth in modern finance, that the vast majority of collateral used today is unreliable. Think about real estate. It depends on zoning laws and lack of hailstorms and lack of floods. It depends on political incentives, local economic cycles. Government bonds depend on the credibility of the institutions that repeatedly undermine themselves. Corporate assets, they depend on conditions that vary wildly across industries and jurisdictions, and investors pretend that these uncertainties are manageable, but they are priced through guesswork that has accumulated decades of bad habits. And Bitcoin is now entering the scene with properties. The properties of Bitcoin itself, they erase entire categories of risk. That's correct. Properties of Bitcoin erase entire categories of risk. Bitcoin is globally liquid at all times. It cannot be diluted. It is not bound by geography. It carries no maintenance burden. It has no dependency on regulatory favors. The only variable is price movement, and that variable is visible every single second of the day. In other words, any uncertainty is totally honest. There are no hidden conditions disguised as stability when it comes to Bitcoin. So now anyone with a functioning brain can now see that this immediately raises a problem for the legacy credit system. The system is accustomed to collateral that degrades quietly. Remember, buildings, they deteriorate. The corporations, they'll miss revenue targets. They'll go out of business, but none of this appears in real time. These problems, they will sometimes show up months or years later when auditors, regulators, or ratings agencies finally acknowledge what everyone is already suspecting. Investors tolerate this because they have no alternative until Bitcoin has entered the picture. And Bitcoin removes all of those delays because it broadcasts its status without intermediaries. The market can verify the collateral directly, and this level of transparency is unprecedented in credit markets, and it exposes how the old system was totally dependent on opacity. A balance sheet that's backed by Bitcoin does not require trust in any regulators, management teams, or political promises. It requires the ability to read a ledger. The barrier to verification collapses to near zero. And the irony is that the critics of Michael Saylor and digital credit, they latch onto Bitcoin's volatility as if volatility is disqualifying. Remember, in legacy finance, volatility is often a cosmetic feature. A company can suppress their volatility on paper while its fundamentals will just rot. A government can keep bond yields low only because some central bank will intervene. This whole thing called price stability in the fiat money markets, they often reflect manipulation rather than genuine strength, and Bitcoin does not participate in that theatrical game. It reflects supply and demand without any distortion. And once you recognize this, you will see why Bitcoin becomes the hardest collateral base available. Not because it behaves perfectly, but because its properties are fixed. Investors can model its behavior using market data rather than committee decisions. It is a collateral base that cannot be altered by elections, emergencies, or policy interventions. That alone transforms the risk profile of any credit instrument that's built on top of it. The financial world has spent decades inflating confidence by subsidizing fragility. And Bitcoin reverses that pattern. It forces discipline on issuers, transparency on markets, and accountability on institutions. A credit instrument that is backed by Bitcoin begins on firmer ground than one that's backed by political discretion or physical assets that age, degrade, and depend on legal processes. The collateral improves while the system around it is still pretending that nothing has changed And this is why digital credit products like Strategy's preferred equities, they are so destabilizing to legacy frameworks because they reveal that the market finally has access to a form of collateral that does not rely on human discretion. And that realization alone is enough to disrupt the hierarchy of capital markets that has gone unquestioned for centuries. And this is why you are seeing the legacy system fight Michael Saylor and Strategy tooth and nail, because they cannot compete with Bitcoin. Digital credit only sounds exotic because people spent their entire careers assuming that collateral must come from a dying balance sheet. When you replace that with a monetary base that can't be altered, the financial industry, clearly, this is not my opinion, the financial industry has reacted as if someone has unplugged its life support. In reality, though, the structure is very simple. The investors provide dollars, the issuer secures those dollars with Bitcoin, and yield is delivered through predictable coupons rather than some political improv. So the digital credit model is really easy to understand if you strip away all of your legacy assumptions, because remember, traditional debt depends on a very long chain of conditions. Digital credit is a lot more simple. Think about traditional debt. The management team must execute, regulators must behave, consumers must spend their money, politicians must avoid catastrophic decisions, rating agencies must pretend to be competent. Every link in that chain introduces a different failure point. They are everywhere in the traditional system, and investors accept this because they have been conditioned to believe that uncertainty is unavoidable in the market. Now think of every single one of those failure points in the traditional system. Coin-backed credit removes all of them because the collateral is verifiable. The issuance is finite. The structure is visible in real time. There is no hidden dependency on earnings projections or forward guidance. That the asset that is anchoring the debt does not care about revenue cycles, consumer sentiment, or political intervention. It is a fixed supply instrument that settles instantly and trades globally. And this is the part that confuses traditional analysts because they search for EBITDA coverage ratios and discount cash flow models because those tools were designed for businesses dependent on discretionary money and physical assets, but digital credit operates on a foundation that doesn't degrade with time. The issuer can acquire more Bitcoin, refinance earlier placements, and scale the collateral base without introducing all of those usual distortions that plague the corporate debt markets. The critics will often try to map the structure onto legacy bonds and become frustrated when the categories fail. They expect a cash flow engine, yet the central engine is the balance sheet itself. They expect vulnerability to currency volatility, yet the collateral exists outside the currency system entirely. They expect political risk, yet the asset is totally indifferent to the conditions that usually destabilize collateral. Their models don't break because the product is strange. Their models break because they were built for an environment that no longer reflects reality. Digital credit is simply debt secured by a superior collateral base. So the confusion for these people should evaporate pretty easily once you internalize that reality. The innovation is not in the coupon, even though it's higher, or the fiat funding. The innovation is the integrity of the collateral. You are no longer relying on a physical asset with jurisdictional baggage. You are relying on a digital asset with mathematically enforced scarcity. And this is why it's breaking everyone's brains. This is why these instruments are such a shock to the system. They demonstrate that the quality of collateral can increase without increasing complexity. They allow issuers to build capital structures that do not degrade under inflationary regimes. They give investors yield without requiring loyalty to institutions that have repeatedly failed to safeguard their purchasing power. People like to treat this revolution like it's some sideshow, but digital credit is not a sideshow. It is the future. It is the first credible upgrade to the architecture of debt markets in decades. A balance sheet that is backed by Bitcoin. It will always behave differently from one backed by the old world, and every credit instrument that is issued on top of it benefits from that difference. The industry will eventually adapt, but for now, the advantage belongs to those who understand the mechanics before the crowd catches up. Those who build around the digital credit infrastructure will inherit incredible riches. This is not financial advice, this is financial entertainment, but that's my humble opinion. Credit markets, they claim to be disciplined, but remember, most of their discipline is a performance because analysts, they pretend volatility charts are a proxy for real risk, even though those charts are shaped by political intervention more than any underlying fundamentals of the asset. These rating agencies, they pretend to quantify default probabilities, even though their models depend on the same assumptions that have failed in every single major crisis. The entire system is built around these measurement tools that collapse at the moments the base layer stops inflating on command. And Bitcoin is just disrupting all of those tools that are utilized by the legacy system because traditional risk modeling assumes that collateral exists inside of the fiat system. But we know the reality. Every single calculation relies on the belief that central banks will just intervene when markets break, and that belief distorts how risk is priced. A sovereign bond with catastrophic fiscal conditions receives a yield discount because the central bank stands ready to suppress volatility. None of this is rational. It is a Pavlovian response created by decades of monetary intervention, and digital credit just breaks all of that conditioning. We're going to continue to see all of these analysts retreat into their volatility metrics because that is the only variable that they understand. And you know what's really funny? The people who really just don't get this are the people with credentials. And this is why I love AI, because it's making credentialism dead and more irrelevant as time goes on. Say what you will about AI, but it's kind of democratizing access to information, and people like me get to learn and understand these things faster than the people who went to these communist brainwashing institutions known as the university system. These people, they completely ignore structural risk that is totally embedded in the fiat-denominated instruments, and they cannot wrap their heads around these things. But remember, they have a Harvard MBA, so they're right, of course. These people, they focus on price movements while they're ignoring balance sheet erosion. They're treating the surface level stability as if it reflects real durability, but it does not. Sorry, you people are wrong. Credentialism is dead, and all of these analysts are totally incorrect about everything relating to digital credit and MSTR. The reality is that this is not risk assessment. This is what I call intellectual inertia. The models persist because the industry is terrified of rewriting them. Rewriting the models, that requires admittance that decades of discount rates, yield curves, and collateral valuations were built on conditions that no longer hold. It is an empire that is built on sand. Rewriting the models requires admitting that the safest collateral is no longer controlled by any of the institutions that define the fiat system. This is a war for the future of capital. And because it's a war for the future of capital, that admission would trigger a repricing across the entire fixed income landscape, and the fixed income landscape is hundreds of trillions of dollars of capital. And instead of confronting this, the critics are going to attack Bitcoin-backed credit because it exposes the weakness of their frameworks. They will dismiss it as speculative while they're endorsing sovereign debt issued by governments that have already lost control of their fiscal trajectory. The national debt is going to be over $50 trillion by the time Trump leaves office. They demand higher coupons from structures backed by a scarce asset, yet happily accept lower yields from issuers whose only solvency plan is more printing of fiat money. This inconsistency that we are witnessing is not rational error. It is something that I am calling psychological resistance. They have to do this. They are rationalizing it in their heads. Sorry, folks, but structural integrity matters a lot more than smooth price lines on a chart. This is why the yield on Bitcoin-backed instruments appears high and people think it's too good to be true. This reflects disbelief, but not factual analysis, okay? Investors will price the product through outdated frameworks, which creates the opportunity for anyone capable of thinking outside the boundaries of the the old system. The asymmetry right now is the opportunity. The correction will come. It can't last forever, and it will be decisive. Markets always converge to reality eventually. They simply fight harder when the correction requires admitting that the foundation that they have trusted for decades was fundamentally flawed. At this point, the implications for corporate finance become totally unavoidable. A company funded by traditional credit structures operates under a permanent handicap. Its borrowing costs reflect the weakness of fiat collateral and the unpredictability of policy and the fragility of the assets that will degrade over time. Think about a real estate company. How difficult would it be to liquidate $1 billion of real estate, right? Versus how easy would it be for a Bitcoin company to liquidate $1 billion of Bitcoin? The corporations, they pay inflated rates not because they're dysfunctional, but because the system that they operate in is structurally unstable. That instability is packed directly into their cost of capital. Now, if you imagine a corporation that decides to anchor its balance sheet to Bitcoin, such as Strategy or Metaplanet, the market sees that collateral that cannot be diluted, cannot be seized through administrative shortcuts, and cannot be devalued by monetary policy. For the first time, a corporate balance sheet can now scale with a monetary base that is transparent and predictable instead of political and reactive. And this creates a funding advantage that the legacy finance system is not prepared to compete with. They have no chance at stopping this thing. The genie is out of the bottle, the cat is out of the bag. There is nothing they can do. And that is because a company that accumulates Bitcoin can issue credit at terms that outperform any competitors who rely on the traditional system. Investors, they receive their yield that's backed by scarce collateral. The issuer receives capital at a lower real cost because the risk profile is a lot cleaner. The structure aligns incentives rather than obscuring them behind accounting conventions and also policy assumptions too, and that is why the corporations without Bitcoin will experience increasing pressure over time. Their cost of capital will forever drift higher relative to firms that build Bitcoin treasuries. They will rely on collateral that weakens quietly, while competitors rely on collateral that strengthens during periods of monetary instability. The market will reward the company that chooses a predictable base layer over one that decays through awful hyperinflation and policy swings. And if you think this shift stops at individual firms, absolutely incorrect. Entire industries depend on debt markets for their survival. If one company in a sector adopts a Bitcoin treasury strategy and gains a structural funding advantage, the competitors are going to face a choice. They can do two things. They can either raise capital at worse terms or adopt the exact same strategy. The equilibrium moves toward the harder collateral because markets will always gravitate towards structures with lower long-term risk. And not to dive too deep into the game theory, but I'm just saying this dynamic is going to reach the sovereign level, the sovereign nation-state level. Think pension funds, think endowments, think multinational corporations as well. They are all going to demand credit instruments that preserve real value instead of eroding it. Bitcoin-backed credit satisfies that requirement directly. It offers predictable collateral, global liquidity, and insulation from any sort of physical risk. And this is how the yield curves will begin to shift because the market starts pricing risk based on collateral quality rather than institutional prestige fake news nonsense. The process will accelerate once a critical mass of issuers adopt this model because the market will begin to benchmark everything against the hardest collateral available. And you know what's really beautiful about this entire thing? Bitcoin turns corporate finance into a meritocracy again. The firms that build on a hard base layer will outperform those continuing to rely on collateral shaped by political discretion. The markets will adapt because markets always adapt when the difference becomes too large to ignore. This is the end game, a global credit system that rewards discipline, punishes fragility, and functions without dependence on centralized monetary manipulation. Bitcoin replaces the old model entirely. It replaces the foundation and forces the market to adapt to it. The issuers who embrace this structure will thrive. The issuers who cling to the past will watch their funding advantage totally disappear. Fiat is terminal, so this transformation is going to accelerate. The investors will allocate to the structures that actually protect their capital. Every single cycle that exposes fiat fragility will just push more institutions toward Bitcoin collateral. Think of what Michael Saylor did in 2020. He found Bitcoin out of necessity when he saw the Fed print all that stimulus check money. So once the meta narrative, this meta shift of fiat being terminal and the money printer continuing to print, well, it's going to reach critical mass. The system that once dominated global finance will be reduced to a historical reference point. Digital credit becomes the benchmark. Everything else will just adjust to it and not the other way around. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video and subscribe to the channel. I am a warrior on the front lines spreading the orange gospel of Bitcoin to the masses. Our world is changing at breakneck pace, and I want you here with me every single step of the way. Have a terrific day. Do not party too hard. Class dismissed. Once again, a special thanks to Horizon for sponsoring this video. Most people don't realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there's a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual, and then later when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of your home's future value. That is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you continue living in it. What makes Horizon stand out is that there are no term limits and you keep 100% of the Bitcoin upside. The Bitcoin is fully yours to custody however you want, wherever you want, with no risk of forced liquidation. If you've been sitting on a pile of home equity and are eager to invest in Bitcoin, this may be the product for you. Visit joinhorizon.com to see if you qualify and get started. Their team of experts will work with you one-on-one from start to finish. Transform your dormant home equity into Bitcoin today with Horizon.